In many movies, the image of a girl drifting is often used as an artistic device to depict the tension, danger, and helplessness of the character. In a dramatic situation, this is not only a detail to create a sense of suspense. Today, the U.S. stock market continues to be the focus of global investors when major indexes such as S&P 500, Dow Jones, and Nasdaq still maintain impressive growth momentum, even setting new record highs. However, behind that brilliant picture, there are many warning signals from the economy. Private sector employment data released by ADP shows that the U.S. unexpectedly lost more than 30,000 jobs in September, a number that raises concerns about the real health of the labor market. Immediately after this information, bond yields fell sharply, showing that capital flows began to seek safer assets. At the same time, gold prices also broke out, reaching a new peak as investors sought shelter from the risk that the U.S. government could shut down and disrupt the release of important economic data. However, technology stocks, especially those related to artificial intelligence, continue to lead the market. This is the biggest driving force that helps Wall Street maintain excitement for many consecutive weeks. However, it should be noted that current stock valuations are at a very high level. According to experts, when stock prices increase too quickly, while the economic foundation shows signs of weakening, the risk of correction is inevitable. In addition, inflation has not yet returned to the Federal Reserve's target level, limiting the ability to cut interest rates in the near future. Looking ahead, the U.S. market could follow three scenarios. First, maintain the upward momentum. If corporate earnings results are quite optimistic and the Fed stays on policy. Second, fall into correction if economic data is worse than expected or a budget crisis arises. Third, accumulate sideways in a narrow range as investors wait for more clear signals from the employment and inflation reports. In this context, experts recommend investors to be cautious, divide the portfolio, set reasonable stop losses, and closely monitor the developments of monetary policy. It can be said that the U.S. stock market is like a double-edged sword. At the moment, on the one hand, there are still many opportunities from the technology boom and the expectation of interest rate reduction. But on the other hand, there are great risks from the unstable economy. Therefore, choosing defensive stocks, combining holding gold or bonds to balance the portfolio, is the way that many investors are applying to minimize risks in this volatile period.